But now let's talk about something far more troubling. And this is the other side of the equation. So you have Warren Buffett out there who likes a company, does the research, and sees that on any given day, the stock is way below what he believes it's worth, so he buys. But what about those people who are like Warren Buffett in a sense? They are managing a lot of money, but now they're out there and they see certain stocks that they believe are way overvalued. They've done their research just the same, just like Warren Buffett. But based on their research, they're saying, wait a second, this is not worth nearly as much as the market is saying it's worth. We have an opportunity. Let's get short the stock. I want to bet the stock is going down. When you buy a stock, it's called getting long. You're long the stock. You have the stock in your account. When you sell the stock short, okay, you sell it, it's called being short. You're betting the stock is going down. So what you have now, and this is a normal, healthy part of the stock market, you have people betting on both sides. Why not? People bet the stock is going up. People bet a stock is going down. But unfortunately, it gets a lot more seedy and complicated than that, because there are the normal everyday short sellers that are playing both sides. They're long and they're short. And then you have what are called short selling specialists. These are people out there, like you've heard, like Melvin Capitals for one, Citron was another, right, that you know very well, right? I know some of these people. Their business model is quite different. They are looking, hopefully, what they really want more than anything is to find fraud. If they can find a company that has some type of fraud involved that no one knows about, and they're very good, these guys are very smart, they spend a lot of money and they spend a lot of time doing research. They try to find companies that are fraudulent in some way. Someone is stealing, they're overstating their numbers, they're not disclosing their numbers. So if the truth were to come out, or in cases they can't find fraud, but they just believe that the market is so wrong on this one at this given day, they're so crazy, this stock is going to just crash and burn and eventually go out of business. So they start to short. How do you short stock? Well, remember, when you're selling a stock that you don't own, it's no different than anything else that you sell you own. You have to borrow it from someone else. If you want to sell it short, you really got to borrow the stock. Theoretically, you're supposed to borrow the stock. Now, there are some exemptions to that. For example, if you are what's called a market maker, all these firms that are out there, like on the NASDAQ, and they make markets. That's the phrase. They're on both sides. They're allowed to be short or long a certain amount in the normal course of trading to facilitate trading. But that's not what's happening here. These are people that are literally investing hundreds of millions and even billions sometimes. They're investing massive sums of money because they believe a stock is going down and maybe even to zero, either because there's fraud involved, could be accounting fraud, something else going on, or just simply a terrible business that's being overvalued by the market. So they start to short. But here's where the problem starts. Shorting a stock is incredibly expensive. So remember I said you have to borrow shares. Where do those shares come from? Well, they come from the brokerage firms have something called stock loan departments, and they take the stock from accounts of people who own them and are holding it for the long term. They take those shares and they temporarily borrow and they remove them from the accounts, most of the time without the customer's knowledge, because you've signed some form, you didn't realize it. And often, even if you didn't sign them, they do it illegally. It's a really seedy business. And they then charge money to these big short sellers to borrow it. It's called stock loan. Stock loan is an incredibly valuable industry within Wall Street, and it's the most corrupt, seedy business out there. Often, even if you have companies that do not have the stock available for loan, the brokerage firms will work with the large short sellers, and they will allow them to illegally short stocks. And that's how you say, how is it possible? 200% of the company's been shorted. The reason is because the brokerage firms are in cahoots with the large short sellers. They are breaking the law flat out, violating the law. It happens all the time, and it's very corrupt. It's incredibly corrupt. And if you're a company holder, let's say like Elon Musk was going crazy with Tesla, and I love Elon, by the way, and I'm glad he gave the short sellers a nice dose of pain, right? But he was kicking and screaming this company's being illegally shorted. So what happens? Watch the bad part here. So a short seller goes in there and gets really, really short. They borrow all this stock. They sell it. Let's say the stock was $30, and they racking up every single day interest on the short. They got to pay money to stay short. So it's not enough that they are right. that the stock is going to go lower, and a lot lower at that, they have to be right now. Because every day they wait, their profits, if they are right down the road, are ticking away because they keep racking up interest and stock loan payments. Interest on their margin, you have to borrow, so there's margin interest, and stock loan payments they have to make. And it gets incredibly expensive for them to stay short. So what do? They act and do things to precipitate the downfall of the companies they short. And this is the dirty part of Wall Street. And this is what you saw the guys on Wall Street Bets having righteous wrath, or they were right. They're upset because what happens with the short sales, they routinely find companies, they get wildly short, and then they start releasing reports that paint this ultimate picture of doom and gloom, probably far worse usually than the companies really are. They will actually plant articles in magazines, periodicals, on the internet. They'll start talking down stocks in chat rooms. They start doing all the stuff that Wall Street Bets did on one side, which is pretty legal. They were doing it. They do it illegally. They collude with each other, and they try to drive down the prices of stocks now. They call up the government. They say there's criminal wrongdoing. They try to get the FBI to investigate. They try to get investigations going all the time. I am not making this up. This is standard operating procedure for many short sellers. Not saying which ones are doing it, but it's SOP for many short sellers. Once they get short, they are forced now to make sure their bet pays off in the near term, not in the long term. And that, my friends, is the difference between the longs and the shorts. The longs, like a Warren Buffett, he's in no rush for his bet to pay off. He'd love it to pay off sooner than later, but he's not losing money every single day because he's probably not on margin. And in fact, the companies he's buying are paying dividends. They're more mature companies typically, and they actually pay dividends. At the end of the day, all value comes down to that, the perception that one day the stock will be large enough they can start paying dividends, meaning they will distribute money back to the shareholders. That's the ultimate form of value for big companies. So what is it's called the yield? How much do they pay back to shareholders for each share? Okay, I don't want to complicate the matter here. I want to sort of keep it simple with this one big difference that no one is getting here between longs and shorts. The longs are not in a rush. Other than that, they want to outperform the next hedge fund so people will have confidence and keep investing with them. The short sellers are losing money on a moment-to-moment basis every second their bet hasn't paid off. So they're forced to do things that are going to precipitate the fall of a stock. They get vocal, they get loud, they collude with each other, they spread bad news, they try to start investigations, all that sort of stuff. And it's commonplace every day, and it's still happening all the time. That is what caused the wrath of Wall Street Bets. It's that activity for a company like GameStop, which frankly, you could love it or you can hate it. Doesn't matter. But it's not a fraud. GameStop, to my knowledge, and again, I don't know, it could be, it's not a fraud. There's nothing wrong with GameStop. Other than that, maybe you'd say, well, they're like Blockbuster Video. Fair enough. Okay, that they're in the raw, they're selling buggy whips now in 1905, right? Bad industry. You could say that. You could say it's out of date. It's no future. The store's been hit by fine. Fair, all reasons why you say the stock is currently overvalued and going lower. But I'd be hard pressed to find someone who said there's fraud involved, that they're criminals. That's not the case. So what happens is you're looking at a situation where these people got so short because they didn't like the company. They got so short and had to now pound it down, and they had to do things to precipitate the fall even further. That created the opportunity that Wall Street Bets jumped into.